What if I told you that right now, despite all the noise, volatility, and economic uncertainty, the stock market might actually be offering better risk-reward opportunities than it did before the trade war even began? Well, that's exactly what Tom Lee from Fundstrat just said in a recent CNBC interview. And when Tom talks, smart investors tend to listen. According to him, there's still serious upside in stocks, and any pullbacks we see from here on out, he says they'll likely be shallow because investors are still underexposed and skeptical. In this video, we're diving deep into that interview. First, I'll play you the clip from Tom Lee's appearance on CNBC's Closing Bell. Then I'm going to break down what he really meant, react to the key points he made, and explain why his outlook could be a big deal for your portfolio. And to finish it off, I'll give you my own analysis of 2 undervalued stocks that I think are worth your attention right now, based on where the market's headed. If you only watch one video today, trust me, make it this one, and make sure to stick around to the end. It could seriously shape how you invest in the coming months. Before we jump in, hit that like button so we can push this video out to more investors. Let's try to get this video to 1,000 likes. Drop a comment with your thoughts on Tom Lee's outlook, and of course don't forget to subscribe so you never miss a major financial update like this. Alright, let's hear what Tom Lee had to say.
And our next guest argues the risk-reward is much better now than even before the trade war started. Fundstrat's Tom Lee is a CNBC contributor and joins us now from Miami. It's good to see you as always. How's that possible? How's the risk-reward better now than then?
Scott, I think when we go back to February when the market was at all-time highs, we have to keep in mind we had a lot of uncertainties ahead of us, and we weren't necessarily looking at 2026. You know, the tariff visibility is much better today than it was 3 months ago. And when we look at 2026, I think that there are things to look forward to, such as deregulation, tax cuts, and actually a Fed that's on hold now, but probably doing more cuts now in 2026. And then from a company perspective, companies survived, I think, a black swan event. You know, that waterfall decline in equities and the sort of the near heart attack of the economy still was an environment where companies produced earnings that beat expectations. I mean, so this is the 5th stress test for businesses. I mean, when I put all that together, I think PE's probably going to be higher in 6 months than lower. And when you think about 2026 earnings having upside, I think there's still upside for stocks.
So, I mean, because you keep talking about 26, you're not writing off the rest of this year. We still have 7 months to go.
Yeah, we have a lot of history to make between now and year end. But keep in mind that waterfall decline in stocks also was almost a complete reset in positioning and sentiment. You know, investors were forced to liquidate when the VIX hit 60. We know a lot of institutions didn't add risk back as the market rallied. So I think the pullbacks are going to be pretty shallow because investors just are underinvested at the moment. And then when you look at sentiment, it's barely turning neutral now. So if investors have been fighting this rally, as they become more neutral or more optimistic, that's upside for stocks.
I mean, Professor Jeremy Siegel, like you, has grown more bullish, pointing out, in his words, the Trump pivot on the tariffs, but he still acknowledges the fact that the tariffs are likely to remain in place. Whether it's 30 on China and 10 on everybody else, that's still somewhat regressive, is it not?
Yeah, well, I mean, you know, we are now in a new world of tariffs, and businesses are adjusting. I think one of the things that we're seeing is that the market is now in a position where they can start to look through some of the messy adjustments, right? We know there's been a disruption to the supply chain. I think stocks can look through that. But you're right, Scott, there is now this world where there's essentially a consumption tax in place on things that we're importing. But that doesn't mean we have to actually have the PE decline or the markets to fall. It's now just something we have to kind of manage through.
What about yields rising? How much of an issue potentially is that?
Well, I think Fed Chair Powell made a good point that long-term yields could be rising because of inflation volatility rather than inflation expectations going up. That's actually an opportunity for markets because if inflation volatility delivered is less than expected, then we could expect yields to come down in the future.
Yeah, but what about, I feel like the bulls are finding convenient excuses for why the rates on the longer end are going up. What if it simply, Tom, is the fact, and I don't mean to single you out, I mean, the professor in his answer to the question, too, put more credence in the fact that, well, maybe it's because growth is going to be better, not so much the deficit. However, what if finally the bond market is saying enough is enough and it's time to get real? And if you all don't, we will.
Yeah, Scott, there was a moment like that a few years ago when, when an auction went badly and many people declared this was sort of the end of the ability for the U.S. government to finance, and people panicked and the VIX surged. But even in that moment, it proved to be a buying opportunity for equities. So I think if there is a moment where maybe the bond market sort of has a tantrum about that, and I'm not saying it's going to happen, but if it does, I think we have to remember the U.S. is a huge economy. There is still a lot of trust in the U.S., and I think those who've called for the end of U.S. exceptionalism, I think that's been the premature call. And if none of those is true, the bond market and investors can handle even a 4.5-4.7% 10-year.
So Tom Lee kicks off by making a pretty bold claim. The risk-reward setup in the market is actually better now than it was before the trade war began. At first, that sounds kind of crazy, right? I mean, we've been through a global pandemic, a supply chain crisis, war tensions, inflation spikes, you name it. But what Lee is saying here is actually quite strategic. He points out that back in February, when the markets were at all-time highs, there was still a ton of uncertainty. People weren't even sure what the future held beyond that peak. Fast forward to now, and we're talking mid-2025 here, he says the visibility is a lot clearer. The big issues like tariffs, for instance, are no longer looming question marks. They're baked into the system. Businesses have started adjusting, and that kind of stability, even if it's messy, makes planning easier and investing less risky. Now, this is where it gets interesting. Lee zooms out and focuses on 2026, not just the short term. He talks about potential positives, possible deregulation, tax cuts, and most importantly, a Federal Reserve that's likely to pivot toward more rate cuts. That's a big deal. And let's not overlook this part. He says companies have essentially passed a fifth stress test. Think about that. He's referring to events like the pandemic crash, inflation shocks, interest rate spikes, and yet these companies have still managed to beat earnings expectations. In his eyes, that resilience is proof that they're stronger than ever, and it sets the stage for growth. Next, the conversation shifts toward the rest of this year. 2025 isn't over yet. Tom Lee isn't ignoring the remaining 7 months, but he points out something that really resonates. The market's waterfall decline earlier this year completely reset investor positioning. When the VIX, the fear index, spiked to 60, a lot of institutional investors were forced to sell, but as the market rallied, many didn't buy back in. That means there's a huge chunk of investors who are underexposed right now. So any dips or pullbacks in the market, he thinks they'll be shallow because buyers are just waiting on the sidelines to re-enter. He also notes that investor sentiment has only recently turned from negative to neutral. And as more investors shift from fear to optimism, he sees that as fuel for more upside in stocks. The interview then moves to the topic of tariffs. And this is where Scott Wapner, the host, pushes back a bit. He brings up that the tariffs might be here to stay. 30% on China, 10% on other countries. That's not exactly bullish news, right? But Lee shrugs it off. He says businesses are adapting to this new reality. And even though we're essentially living in a world with a consumption tax on imports, it's not necessarily bearish. The market can see through the noise now. In his words, it's something we just have to manage through. And he's not wrong. The supply chains have already started evolving. Companies are reshuffling where they source goods from, and consumers are slowly adjusting to higher costs. In other words, the adjustment period is already underway, and markets are forward-looking. They're pricing in what comes next, not what's already happened. Now let's talk rising yields, which is always a hot topic. Higher long-term yields typically spell trouble for stocks, right? They make borrowing more expensive, put pressure on valuations, and can slow growth. But Tom Lee has a different take. He says Fed Chair Powell made an important distinction. Long-term yields might be going up not because of inflation expectations, but because of inflation volatility. That's a subtle but crucial difference. If the market expects wild swings in inflation, it prices in a higher risk premium. But if actual inflation comes in smoother than expected, yields could drop back down, and that would be a tailwind for stocks. Now, Wapner challenges him here again, saying maybe the bond market is just waking up to reality. Maybe it's not about growth or inflation volatility. Maybe it's about the deficit and the bond market saying enough is enough to all the government spending. Lee acknowledges that possibility, even referencing a past scare when a bond auction went badly, and everyone thought it was the end of U.S. fiscal dominance. But here's the key point he makes. Even in that panic, it ended up being a buying opportunity for equities. And he firmly believes that anyone calling for the death of U.S. exceptionalism is making a premature call. He argues that the U.S. is still a dominant economy with massive global trust. And while bond market tantrums can shake things up, they usually don't destroy long-term equity value. In fact, they often create discounted buying moments for investors who stay calm and think long-term. So to sum it all up, Tom Lee is still bullish, not blindly optimistic but strategically confident. He sees a market that's come through serious storms and come out stronger. With corporate earnings holding up, sentiment still recovering, and structural shifts like deregulation and rate cuts on the horizon, he believes there's real upside ahead. Even with tariffs, higher yields, or debt concerns, he's saying, don't underestimate this market. The risk-reward is better now, not worse. And if you're an investor who's been sitting on the sidelines, this might just be your moment to rethink your positioning. As always, these are just insights, not financial advice. But Tom Lee definitely gave us a lot to think about. Let me know in the comments what you think. Is he right to be bullish? Or are there red flags that we shouldn't ignore? If you enjoyed this breakdown, don't forget to like the video and subscribe for more deep dive market commentary. Alright, let's jump right into our first of two undervalued stocks to buy right now. Biogen Inc., ticker symbol BIIB. This company is a titan in the biotech industry and there's a lot to unpack here. Now, if you're not familiar, Biogen is a big deal in the world of biotechnology. Founded in 1978, they've been at the forefront of scientific innovation for decades. They're focused on developing therapies for some of the most complex and challenging neurological diseases out there, which is no small feat. Things like multiple sclerosis, spinal muscular atrophy, and even Alzheimer's disease. These are conditions that affect millions of people globally and have a significant impact on quality of life. We're talking about cutting-edge science here, folks, the kind of stuff that has the potential to change the lives of millions of people around the world. It's not just about treating symptoms, it's about finding cures and improving lives, the kind of stuff that has the potential to change the lives of millions of people around the world. Imagine a world where neurological diseases are a thing of the past. That's the future Biogen is working towards. Now I know what you're thinking, biotech is risky, and you're not wrong. Developing new drugs is no walk in the park. The path from research to market is fraught with challenges. And you're not wrong, developing new drugs is no walk in the park. It's a long, arduous process that requires significant investment in both time and money. It's expensive, it's time-consuming, and there's always the chance that a drug that shows promise in early trials might not pan out in the long run. Clinical trials can be unpredictable, and setbacks are part of the journey. But here's the thing, Biogen has a proven track record of success. They've navigated these challenges before and come out on top. They've been in the game for over 40 years, and they've got a portfolio of blockbuster drugs that generate billions of dollars in revenue every year. Their products are trusted by healthcare professionals and patients alike. And that's not all. Biogen is also investing heavily in research and development, constantly pushing the boundaries of what's possible in the world of neuroscience. Their commitment to innovation is unwavering, constantly pushing the boundaries of what's possible in the world of neuroscience. They're not just resting on their laurels, they're actively seeking new solutions and breakthroughs. They've got a pipeline full of promising drug candidates, any one of which could be the next big breakthrough in the fight against neurological disease. This pipeline is a testament to their forward-thinking approach. Any one of which could be the next big breakthrough in the fight against neurological disease. The potential here is enormous, and the implications for patients are profound. Now let's talk about the numbers, because at the end of the day, that's what really matters, right? Investors want to see a return on their investment. Biogen is currently priced at around $125.59 per share, which is an astonishing 132% below its estimated fair value of $291.85. With a market cap of $18.4 billion and an earnings per share of $10.16, Biogen holds a relatively low price-to-earnings ratio of 12.36, suggesting that fundamentally the stock may be undervalued. In 2024, the company brought in $9.68 billion in revenue and posted a net income of $1.63 billion, giving it a healthy profit margin of 19.7% and a return on equity of 9.76%. Now, despite ongoing discussions around drug price reductions, most notably from former President Trump's initiatives, pharmaceutical stocks like Biogen have remained surprisingly resilient. This shows investors still believe in the sector's ability to weather regulatory storms. Biogen's strong demand for rare disease treatments helped it beat profit and revenue expectations in the first quarter of 2025, even as sales from its multiple sclerosis line declined. Adding to that momentum, the company scored a significant win with the European Union's approval of 𝗗𝗚𝗏, its new Alzheimer's drug. It's now the first therapy authorized in the EU to actually slow early-stage Alzheimer's progression, a major milestone not just for Biogen, but for Alzheimer's research globally. But it's not all smooth sailing. While the company exceeded revenue expectations, it did miss on earnings per share estimates for Q1 and even reduced its EPS guidance for the year. This has introduced a bit of investor caution. There's also mounting competitive pressure in the MS treatment market, which could challenge revenue stability moving forward. Even with these headwinds, Biogen's fundamentals and regulatory wins have strengthened investor sentiment. The market appears cautiously optimistic, with a clear focus on how the company navigates these challenges in the months ahead. Biogen is a financially sound company. They've got a strong balance sheet, with plenty of cash on hand to fund their research and development efforts. This financial stability is crucial for long-term success. They've got a strong balance sheet with plenty of cash on hand to fund their research and development efforts. This financial stability allows them to take calculated risks and invest in groundbreaking research. And while their stock price has taken a bit of a hit recently, largely due to some setbacks in their Alzheimer's program, I believe this presents a fantastic buying opportunity for savvy investors. The market often reacts strongly to short-term news, but it's the long-term potential that truly matters. See, the market tends to overreact to short-term news, and in Biogen's case, I think they've overreacted. This overreaction can create opportunities for those who are willing to look beyond the immediate headlines. This is a company with a proven track record of success, a strong financial position, and a pipeline full of potential. Their achievements speak for themselves, and their future looks bright. And when you factor in the aging global population and the increasing prevalence of neurological diseases, the long-term growth potential for Biogen is absolutely massive. The demand for effective treatments is only going to grow. The long-term growth potential for Biogen is absolutely massive. As the global population ages, the need for innovative neurological treatments will become even more critical. So if you're looking for a stock with the potential to deliver both value and growth, Biogen is definitely worth a closer look. This is a company that's not just about profits, it's about making a real difference in the world. This is a company that's leading the charge in the fight against some of the world's most devastating diseases, and I believe that their best days are still ahead of them. Their commitment to improving lives is truly inspiring, and I believe that their best days are still ahead of them. With their strong foundation and innovative spirit, the future looks incredibly promising for Biogen. Remember, this is just my opinion, and you should always do your own research before making any investment decisions. Investing in biotech can be rewarding, but it's important to be well informed. Now let's move on to our second stock, and this one's for all you energy investors out there. We're talking about Diamondback Energy, ticker symbol FANG. Diamondback is an independent oil and natural gas company, and they're one of the largest landowners and operators in the Permian Basin, which, if you don't know, is basically the holy grail of shale oil production here in the United States. Now I know what you're thinking. Oil and gas? Isn't that like so yesterday? And yeah, I get it. With all the talk about renewable energy and the transition to a greener future, it's easy to think that oil and gas are on their way out. But here's the thing. The world still runs on oil and gas. And it's going to continue to run on oil and gas for many years to come. The demand for energy is only going up, and Diamondback is perfectly positioned to meet that demand. They've got a massive acreage position in the Permian Basin, which gives them access to some of the most prolific oil and gas reserves in the world, and they're incredibly efficient at what they do. Diamondback has consistently been one of the lowest cost producers in the Permian Basin, which means they can generate profits even when oil and gas prices are relatively low. And speaking of oil and gas prices, let's be real, they've been all over the place lately, right? But here's the thing. Diamondback is built to weather the storm. They've got a strong balance sheet with low debt levels, and they've hedged a significant portion of their future production, which means they're protected from short-term fluctuations in commodity prices. But here's what really gets me excited about Diamondback: their commitment to returning value to shareholders. They've been consistently increasing their dividend, and they've also been buying back their own stock, which is a great sign. It tells me that they believe their stock is undervalued and they're putting their money where their mouth is. The company is currently trading at $141.13 per share, about 118% below its fair value estimate of $307.72. With a market cap north of $41 billion, a high earnings per share of $16.38, and a PE ratio of just 8.62. This energy stock also appears significantly undervalued. In 2024, Diamondback pulled in $11.02 billion in revenue and $3.34 billion in net income. The stock offers a healthy dividend yield of 3.71%, which adds another layer of appeal for income-focused investors. In the first quarter of this year, Diamondback posted strong earnings, outperforming expectations with an EPS of $4.54 against the projected $4.09. The company generated $1.5 billion in free cash flow, further demonstrating its operational efficiency and strong financial footing. Even in a shaky market, Diamondback returned $864 million to shareholders through dividends and stock buybacks, underscoring its commitment to delivering shareholder value. Operationally, the company continues to benefit from a deep inventory of high-return drilling sites in the Permian Basin, a critical asset that supports long-term production even when oil prices fluctuate. Despite recent pressure on the stock price, the company's core fundamentals remain strong. Diamondback's ability to generate consistent cash flow, maintain efficient operations, and return capital to shareholders makes it a stock worth watching as the energy market works through its current volatility. So, if you're looking for an undervalued energy stock with a strong track record, a solid financial position, and a commitment to shareholder value, Diamondback Energy is definitely worth checking out. This is a company that's at the forefront of American energy production, and I believe they have the potential to deliver significant returns for investors in the years to come. Again, this is just my opinion, and you should always do your own research before making any investment decisions. The energy market is complex and ever-changing, and it's crucial to stay informed. Keep an eye on the latest trends and news in the energy sector to make well-informed decisions. Remember, investing is a long-term game, and patience is key. Diversifying your portfolio can also help mitigate risks and enhance potential returns. The future of energy is bright, with growing demands and evolving technologies. Companies that adapt and innovate will likely lead the way in this dynamic landscape. Stay confident, stay informed, and make smart investment choices. Diamondback Energy could be a valuable addition to your investment portfolio. Take a closer look, do your research, and see if it aligns with your investment goals. The energy sector offers numerous opportunities, and Diamondback Energy is one to watch. Make informed decisions and invest wisely for a prosperous future. Both Biogen and Diamondback Energy showcase how solid fundamentals and strategic positioning can present long-term value, even when short-term market sentiment is mixed. For investors looking for undervalued opportunities, these two names deserve serious consideration. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. Imagine having the knowledge and confidence to make informed investment decisions that can significantly impact your financial future. This is not just about making quick gains, it's about building a sustainable and prosperous financial foundation. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. These are time-tested strategies that have helped countless investors achieve financial independence and success. The course is structured to be comprehensive yet easy to follow, ensuring that you can apply these principles regardless of your current skill level. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments, no matter what the market throws at you. We dive deep into financial statements, market trends, and economic indicators to give you a holistic understanding of the investment landscape. This practical approach ensures that you can make informed decisions with confidence. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. You'll have access to exclusive resources, including detailed case studies, interactive quizzes, and one-on-one mentorship opportunities. This personalized support is designed to help you overcome any challenges you might face on your investment journey. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. Each module is crafted to build on the previous one, ensuring a seamless learning experience. By the end of the course, you'll have a robust investment strategy tailored to your financial goals and risk tolerance. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Don't miss this opportunity to transform your financial future. The sooner you start, the sooner you can begin reaping the benefits of smart investing. Trust me, your future self will thank you. Imagine looking back a few years from now, proud of the financial decisions you've made and the wealth you've accumulated. This course is your first step towards that future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, then you need to be part of our community. Join the Stocks Galore Patreon today and take your investing game to the next level. Our Patreon members get access to exclusive content, including detailed stock analyses, market forecasts, and personalized investment advice. It's a community of like-minded individuals all striving for financial success. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. You'll gain access to a wealth of knowledge and resources that can help you make better investment decisions and achieve your financial goals. Link is in the description. Don't wait, join us today and start your journey towards financial freedom. What do you think about Biogen and Diamondback? These are two companies that have been making waves in the market recently. Are they on your watch list or are you already invested? Let me know in the comments below. I love hearing from you and learning about your investment journeys. Share your thoughts in the comments and subscribe to the YouTube channel. Stay tuned for more tips, strategies, and insights to help you invest smarter and build a brighter financial future. See you in the next one.